All right, get ready to dive into some heavy machinery today.
Okay, sounds good.
We're looking at Action Construction Equipment, Ltd.
Uh-huh.
An Indian company. They make everything, cranes, tractors, you name it.
Interesting.
We've got screeners' insights and financials for this deep dive. So let's see what we can dig up.
Yeah, let's get into it.
First off, how did they do in Q2 of FY25? Let's start with revenue. How'd that look?
Well, looking at their quarterly results, their revenue jumped up quite a bit, actually.
Oh, yeah.
To 757 crore rupees in September 2024.
Okay.
Big increase compared to the same time last year, which was 673 crore rupees.
Wow. What kind of growth are we talking here?
That's about a 12.5% growth rate.
Okay, that's impressive.
Yeah, pretty impressive.
But revenue's just one side of the coin.
Right.
What about their profitability? Did they become more efficient?
Well, their operating profit margin's a good indicator of that,
Right.
and it's a positive story.
Okay.
In September 2023, it was 13%. A year later, it climbed to 14%.
So squeezing more profit out of each rupee.
Exactly, yeah.
Okay, so they're growing and becoming more profitable,
It seems so.
which is great. But to get a better idea of profitability, what can you tell us about their EBITDA margins?
Well, using the quarterly results table, we see their EBITDA margin also went up from about 16% in September 2023 to around 18% a year later.
So they're managing their operating costs better.
Basically, yeah, becoming more efficient.
Okay, things are looking up. Now, let's talk about profit after tax, PT.
Now that's where things get interesting.
Okay, tell me more.
Pat took a huge leap from 88 crore rupees in Q2 of FY24 to 95 crore rupees in the same quarter of FY25.
So how much of an increase are we looking at?
That's an 8% jump.
Wow.
Quite healthy, especially in this industry.
Very impressive. Looks like this company is doing really well. Now, let's focus in on one specific thing, debtor days.
Okay.
The source shows it decreased. But for someone who's trying to understand a company, is that a good or bad thing?
That's a good question. In this case, it's definitely a good sign.
How so?
Debtor days tells you how long it takes the company to get paid by its customers.
Right.
Action Construction Equipment went from 30.5 days down to 20.6 days.
Oh, wow.
So they're getting paid faster, meaning more cash in hand to reinvest or even pay dividends.
So lower debtor days means better cash flow management.
You got it.
Now, speaking of cash, what about free cash flow, FCF? What can we tell from what we have here?
FCF, that's what a lot of investors want to see, right?
Absolutely.
It's the leftover cash after covering operating expenses and capital expenditures.
Exactly.
We don't actually have the FCF numbers here.
Okay.
But the trends we've been talking about, like profitability going up and shorter collection times,
Yeah.
they all suggest that Action Construction Equipment is probably generating a decent amount of free cash flow.
Okay, so even without the number itself, we can get a sense of their cash flow.
Exactly.
Now let's take a deeper look at some key ratios. First up, PE ratio. It's at 46.1. What does that say about how investors feel about the company?
The PE ratio, or price-to-earnings ratio, basically shows how much investors are willing to pay for each rupee of the company's earnings.
Okay.
So a high PE, like this one, it could mean that the market expects big growth from Action Construction Equipment in the future.
Oh, interesting.
They're betting those earnings are going to increase a lot, justifying the high price tag.
So investors are pretty optimistic then.
Yeah, you could say that.
But the source also mentions a potential problem. The stock's trading at 12.2 times its book value.
Right.
Could you break that down for us and how it relates to the PE ratio?
Sure. A high book value multiple, like we see here, just backs up what the high PE is already telling us. Investors are willing to pay a premium for Action Construction Equipment's assets. They believe the company is going to make big returns on those assets.
So both are pointing towards high expectations for the company's future. Now let's switch gears to debt. The source says Action Construction Equipment is almost debt-free. Where can we see that in the numbers?
Just take a look at their balance sheet. Their debt is super low. If you look at their total liabilities, which were 2,321 crore rupees as of September 2024, and compare that to their total assets, same amount, you can see they're not using much debt at all.
So they're being careful, not taking on too much risk.
Yeah, especially smart in an industry like this one.
But how does low debt affect the interest coverage ratio?
Well, the interest coverage ratio tells you how easily a company can cover its interest expenses with its earnings.
Makes sense.
Now, we don't have the ratio given to us directly,
Okay.
but we can figure it out using EBIT and interest expense from the profit and loss table. Given their low debt and healthy profits, I think it's safe to say their interest coverage ratio is very strong.
So no problem paying off their interest.
Exactly.
Let's talk about the quality of their earnings now. What can the PAT to CFO ratio tell us about that?
The PT to CFO, or profit after tax to cash flow from operations, is a good measure for that. It basically shows how much profit is actually turning into cash.
Right.
And if we look at the profit and loss and cash flows tables,
Yep.
we can see Action Construction Equipment has a high PAT to CFO ratio. That means a big chunk of their profits are becoming actual cash flow. Very positive.
Okay, so they're not just making profits on paper.
Definitely not.
Good to know.
Yeah.
Now, there are two more profitability ratios that stood out, ROCE and ROE.
Yeah, the source highlighted them as very strong.
For good reason, but can you explain what these acronyms mean and why they're so important?
Absolutely. ROCE stands for Return on Capital Employed, key indicator of how well a company is using its capital to make money.
Okay.
ROE, that's return on equity, which measures profitability compared to shareholder equity.
Right.
Looking at the key points and ratios sections, Action Construction Equipment has a 42.3% ROCE and a 30.6% ROE.
Those are impressive numbers.
They are. It means they're very efficient at generating profits from their investments and from the money shareholders have put in.
Okay, so they're making the most of their resources.
It seems so.
For our last ratio, let's look at asset turnover. What does this one measure, and why is it important for a company like Action Construction Equipment, with so much invested in machinery and equipment?
Asset turnover basically tells you how efficiently a company is using its assets to generate revenue.
Okay.
Now, we don't have the exact ratio right here, but we can calculate it from their financials. For a company like this one, a high asset turnover ratio is crucial. It means they're getting the most out of their investments in all that machinery, actually turning those assets into sales.
So it's all about making those assets work for them.
You got it.
We've covered a lot about their financials, and they're clearly doing well. But numbers only tell part of the story.
Right.
Let's talk about the people behind the company. Who are the key players making this happen?
To answer that, we need to look at the shareholding pattern tables. These tables break down ownership into different categories: promoters, foreign and domestic institutional investors, and the public.
Interesting.
And what's really interesting is how the promoters' holdings have shifted over the past year.
You mean that small dip from 66.76% to 65.41%?
Exactly.
What could be causing that change, and should our listener be paying attention to it?
Well, promoters are usually the founders or big players with a lot of influence in the company.
Okay.
So even a tiny decrease like this could mean a few things. Maybe a change in strategy, maybe they're less confident, or maybe something else altogether. It's something to look into.
Yeah, it's like we're trying to solve a puzzle, figure out why these ownership changes are happening. But before we go deeper into that, let's hold on for a second.
Sounds good. So those shifts in the shareholding pattern we were talking about, they can actually tell us a lot about where a company's headed.
You know, that decrease in the promoters' holdings, it got me wondering, could it have something to do with their product portfolio? I mean, they've got cranes, tractors, a bit of everything.
Yeah.
Maybe they're trying to simplify, focus on what makes them the most money.
That's an interesting thought, but actually in this case, their diverse product range is a good thing.
Really?
It lets them cater to all sorts of industries: construction, infrastructure, even agriculture.
Makes sense.
So that diversification can actually help when the economy isn't doing so well. If one sector slows down, they've got others to fall back on.
Right, so it's more like a safety net?
Exactly, yeah. And when you think about the bigger picture, like the growth of infrastructure in India, Action Construction Equipment seems to be in a good position to take advantage of that.
So strong financials, diverse products, and a good market. But I'm still curious about those changes in shareholding. What should our listener be looking for to understand those changes?
It's all about figuring out the motivation behind the changes. Are some investors getting more optimistic while others are maybe having second thoughts?
Okay.
For example, are foreign institutional investors buying more because they see something others don't?
Right.
Or is there something happening internally that's making some investors nervous?
Like we're doing some financial detective work.
Exactly.
Where should our listeners start?
I'd suggest checking the company's news and announcements.
Okay.
See if there's anything recent, like new projects, partnerships, or even changes in leadership. Those things can definitely influence investors.
So connecting the dots between their financial performance, the changes in ownership, and any big news.
Exactly.
Speaking of connecting the dots, let's go back to their financial performance. That jump in their profit after tax was impressive.
Yeah.
But where's that growth coming from? Is it across the board, or are certain products doing better than others?
Good question. Unfortunately, we don't have that level of detail in these sources.
Okay.
We'd need to look at their investor presentations or annual reports to get a clearer picture.
I bet those would be really helpful.
For sure. Listening to what the management team says during their earnings calls can also give you some valuable clues.
Makes sense.
They often talk about their strategy, their priorities, things like that.
Right.
And don't forget about industry reports. They can give you some really important context about the company's competition.
So what we're really saying is this deep dive is just the beginning.
Yeah, exactly. This is just the foundation. The real learning comes from digging deeper, exploring those other resources.
And that's what makes being an informed investor so interesting.
Right.
It's a constant process of learning, understanding more, and making better decisions based on what you find.
Couldn't agree more. Now, before we move on, I want to go back to those ratios we talked about earlier.
Okay.
We touched on some, but I want to make sure our listener really understands how important they are, especially when it comes to making investment decisions.
All right.
Let's start with that PE ratio, the 46.1.
Yeah.
Even for a company like this, with a good track record, what are some of the risks of investing in a company with such a high PE?
Right. High PE doesn't always guarantee future success. So what are some of the downsides?
Well, a high PE might show strong growth potential,
Uh-huh.
but it also means the stock price is already reflecting those high expectations.
Oh, I see.
So there's less room for positive surprises and more risk if the company doesn't meet those expectations. If their performance drops or if investors' feelings change, the stock price could take a hit.
So it's high risk, high reward.
Yeah, pretty much.
Okay. Now let's talk about their almost debt-free situation. We saw how little debt they have, but could that actually be a bad thing?
It might seem strange, but while no debt is usually good, sometimes using debt strategically can actually help a company.
How so?
Debt can give them money for expansion, research, or even acquisitions.
Okay.
All of those things can lead to growth and more profits. If a company is too cautious and avoids debt completely, they might miss out on good opportunities.
It's about finding a balance.
Exactly. Too much debt can weigh them down, but too little can mean they're playing it too safe.
Now, those impressive ROCE and ROE figures.
Yeah.
We talked about how they show the company's efficiency and profitability, but what's the catch? What should our listener be careful about when looking at these seemingly great numbers?
The key is to compare those figures with the industry averages and historical trends.
Okay.
That gives you a better understanding of how they're performing compared to their competitors and their own past performance. Are they doing consistently better than the industry average? Are these ratios going up, down, or staying the same?
Right. So it's all about context.
Exactly. Don't just look at the numbers by themselves. See how they stack up against others.
So it's not just about one moment in time.
Nope. The real story is in the trends and patterns over time.
I'm starting to see how understanding financial ratios is like learning a whole new language.
You got it. And remember, this deep dive is just the beginning. The more you research, the better your investment decisions will be. Now, before we wrap up this episode, I want to get your thoughts on one last important aspect of Action Construction Equipment, their management team. I mean, they're the ones making the decisions, right?
Yeah, absolutely. But we haven't really talked about them much. What can you tell us about the leadership at Action Construction Equipment?
Well, it's always good to look into the management team, their experience, their track record, see if they've had success in the past, if they seem to be making smart choices. Unfortunately, these sources don't give us a lot of details about the specific people in charge.
Okay, so we'll have to do some extra digging if we want to learn more about them.
Exactly. But hey, that's all part of being an informed investor, right?
You got it. It's like putting together a puzzle. Now, we've covered a lot, their financials, those ratios, the ownership changes, even touched on the management team.
Yeah.
It seems like Action Construction Equipment is in a pretty good spot.
They do seem to be doing a lot of things right.
But no company is perfect, right?
Of course not.
So let's shift gears a bit and think about the potential risks. What could cause problems for Action Construction Equipment in the future? What are some things that might slow down their growth or hurt their profitability?
Well, one thing to consider is just the nature of the industries they're in.
How so?
Construction and infrastructure projects, those are heavily influenced by things like the economy, government policies, even the weather.
So their performance might not always be smooth sailing.
Right. If there's less spending on infrastructure or if the economy takes a dip, they could feel the impact. And let's not forget about competition.
True, there are lots of other companies out there making heavy machinery.
Exactly. They've got to keep innovating, keep their prices competitive to stay ahead.
And it's not just about what's happening in India.
No, definitely not.
Global stuff can have a big impact too.
Oh, yeah. Things like supply chain issues, rising material costs, changes in currency exchange rates. All of that can affect any manufacturer, especially one that's operating globally.
So many factors to keep in mind.
And then there's the whole regulatory environment.
What do you mean?
Things like emissions standards, safety rules, labor laws.
Right.
Those can all change. And when they do, it can cost companies money, make things more complicated, and even squeeze their profits.
Okay, so it's not all good news. There are definitely some potential challenges to think about.
For sure, there are. But that's true for any company, isn't it? Every investment comes with some risk. The important thing is to recognize those risks, understand them, and then decide whether or not the potential rewards are worth it.
You know, throughout this deep dive, you've kept emphasizing how important it is for investors to do their own research.
Absolutely. It's crucial.
So before we wrap up, can you give our listeners some practical advice on where to start? What are some resources they can use to go beyond what we've talked about today and really get to know a company like Action Construction Equipment?
Start with the basics. Check out the company's website.
Okay, what should they look for there?
Look for their investor relations section.
Got it.
You'll usually find financial reports, presentations, news releases.
Good stuff.
Definitely.
What about those regulatory filings you mentioned? Aren't those really technical?
They can be, yeah, but they're full of valuable info you won't find anywhere else.
Right. Anything else?
Remember those earnings call transcripts we talked about? Those can give you a peek into what the management team is thinking. You can find them on financial news websites or the company's investor relations site.
So it's like listening in on their strategy sessions.
Kinda, yeah. And for the real deep dive, check out industry reports and what analysts are saying. They can offer great insights into the company, its competitors, the whole market, really.
It's like getting the expert's view.
Exactly. And remember, learning about investing never stops. The more research you do, the more you'll understand and the better decisions you'll make.
All right, well said. We've really explored Action Construction Equipment, haven't we? From their impressive financials to the potential challenges, we've covered a lot. We dug into those key ratios, explored those interesting shifts in ownership, and even talked about the importance of the management team. And as always, we stressed how important it is to do your own research. So, as we wrap up this deep dive, what's the one key takeaway you want our listeners to walk away with today?
Action Construction Equipment. It's a solid company, strong track record, good financials, lots of potential. But like with any investment, you got to do your homework, understand the risks as well as the rewards, and keep yourself updated on anything that could affect how the company does.
Couldn't have put it better myself. Thanks for joining us on this journey into the world of heavy machinery. Until next time, keep learning, keep exploring, and keep investing wisely.